Okay, so free cash flow. This is a very used metric in kind of business analysis because investors really, in the end, how much cash the company's bringing in is cutting through a lot of nonsense and a lot of the accounting uh, ambiguities. Okay, so when an investor is looking at and analyzing a business, they'll oftentimes want to just figure out how much cash am I going to have at the end of the day uh, that is generated from this business. Okay, so um, it's kind of again cutting through the noise, um, and it's seeing just from the existing business, if I just kept it running, how much cash flow am I going to generate each year? So there's a couple of different ways. There's like no standard way that this is calculated. Um, the most common is you just take the cash flow from operating activities minus capex, and we'll see that capex is also, uh, what that means is like some people will say, how much is it just to maintain the current business? Some people will just use from the investing section the total amount of investments made. But that is distorting because if the business is in a growth phase, they're not only investing to maintain the current business, they're trying to grow it, right? So this is why it's ambiguous as to what number is like the right number. There is no right number technically. Okay, so this is kind of the standard. There's free cash flow to the firm, FCFF. Um, this is answering the core question: how much is the cash flow? How much cash does the core business generate, regardless of how it's financed? Okay, so this is an unlevered metric. It does not depend on the other side of the accounting equation, liabilities plus equity, that split. Okay, it's just looking at just from operations. And so what you're doing is you're actually taking this, because again, cash flow from operating activities, the problem with it is that it has interest expense. How much cash interest are you paying? So a company could have the exact same operations, but if it borrowed more money, it's going to have a lower cash flow from operations rather than a company that didn't borrow. So this next one, they're trying to adjust for that financing decision. So it's basically the same cash flow from operating activities minus capex, but now you're taking in the interest expense and adjusting it for how much cash flow that represented. Because this little one minus tax rate is because interest is tax deductible, you have to do an adjustment to get back to the actual cash flow generated. Okay, so now you have this free cash flow from the firm, which is now adjusted for the financing. Okay, and again, capex is debatable. Is it maintenance capex only, or is it growth plus maintenance? So this is a decision that you as a business analyst will make. What is the cash flow number, or sorry, what is the capex number I should use in my analysis? Now, how do you get just maintenance capex? Because again, the company in the financing section of the statement of cash flow, they may be investing for some huge growth, right? So how do you as an analyst decide how much of that is just to maintain the current business? Well, one way is you can look at depreciation expense. Okay, though it is non-cash, it is using the existing capital base and it's depreciating an expense on that. In the next period, it's going to be different because you've bought all these new assets and your depreciation expense is going to change. You're basically saying each period, the depreciation expense is how much your assets have lost value. So you could assume that, well, I need to at least put that much cash back into the business to maintain it. That's one assumption you could make. Now, that could also be, there's reasons why that may not be accurate, but it could be better than just using the investing section of the statement of cash flow. Because again, if a business is in growth phase, they may be investing a lot more. If a business is kind of like sucks and they're not managing their business well, they may not be investing enough to maintain the business. Okay, they're investing cash flow maybe less than the depreciation expense. Okay, so Again, these are things that you as a business analyst will have to make a judgment call on. In the textbook, this is an odd thing. It's totally abnormal, but the textbook includes dividends into this. Okay, that is not industry standard. I don't know why they're presenting that, but for your homeworks, just use what the book is asking you to do because that's what will get marked correct. But I'm just telling you that in industry, dividends are not subtracted out because how much you pay in dividends is arbitrary. The management may decide not to pay a dividend at all, right? So that doesn't change how much cash flow the business is generating. So it's nonsensical to include it, but the book does.